Hello and a warm welcome to our web talk this evening. My name is Sonja Ament. I'm a program manager at the Friedrich Naumann Foundation in Germany, and I will lead you through our discussion today. Today, we will talk about the digitalization of money and what we can learn from Africa's experience with mobile money. And therefore, we have invited three speakers who can report on this topic from different perspectives and backgrounds. But before we dive into that topic and I introduce today's speakers, I would like to take a minute to say a few words about the Friedrich Naumann Foundations, as some of you might participate in one of our events for the very first time. So based on the principles of liberalism, the Friedrich Naumann Foundation for Freedom offers political education in Germany and abroad. And with our events and publications, we help people to become actively involved in political affairs. And on top of that, we also do support talented young students with scholarships. Our headquarters is based in Potsdam, Germany, but we maintain offices throughout Germany and in over 60 countries around the world. And now it's a great honor for me to welcome our speakers for today. Katrin Assenmacher, since 2016, she is head of the Monetary Policy Strategy Division at the European Central Bank. From 2010 to 2016, she led the Monetary Policy Analysis Unit at the Swiss National Bank, and she holds a doctorate and a diploma in economics from the University of Bonn, where she also received her habilitation. Welcome, Katrin. Next.
Thank you, John.
Next, Barry van Huisteen. Barry is a qualified economist with a post-graduation degree in strategic management. Barry's career started in organizational development, after which he spent many years in small business finance and entrepreneurship development before joining Netbank in 1998. There he held several executive leadership positions, among others in card and payments operations and credit management and innovation. Currently, he is the IT divisional executive at Netbank. Welcome, Barry.
Good evening, and thank you.
And Aaron Tegea, he holds a PhD in economics from Oxford University. Currently, he is director of the economic and financial consulting firm Aliquot Limited and has previously worked at the International Monetary Fund, the World Bank, and Lehman Brothers. He is also co-author of the policy paper From Mobile Money to Digital Cash. And this will also kickstart our discussion for today, since he will give us an introduction to the topic and their findings. So, dear Aaron, I'll hand it over to you.
Thank you very much, Sonia, and greetings from Nairobi, Kenya. I'd also like to thank the Friedrich Naumann Foundation for the invitation to speak during this webinar. I'm very happy to speak today about an immensely interesting topic, which is the lessons that Africa's experience with mobile money can provide for the introduction of central bank digital currencies, or CBDCs. So CBDCs are at the heart of discussions and research across the majority of central banks across the world. We're all aware that some countries have already issued CBDCs, such as the Bahamas and China. And CBDCs offer vast potential to transform financial sector intermediation and thereby impact economic growth by increasing allocative efficiency through broadening the reach and availability of financial services, and also lowering the time and costs of transferring resources to productive activity. The objectives for the issuance of CBDCs differ widely and are informed by each country's unique socioeconomic environment and policy objectives. Some of the many policy goals include increasing payment systems access, improving the efficiency and resilience of cross-border transfers, increasing financial inclusion, or securing monetary sovereignty, or even reducing illicit flows of money. Regardless of the objective and design, the realization of the potential of CBDCs is dependent on their successful adoption and widespread use. And this is where mobile money comes in. Although CBDCs are still nascent, mobile money ecosystems have a long history of implementation spanning over a decade, and have had a transformative impact on financial systems in a large number of countries around the world. The mobile money experience sheds light on a number of regulatory, economic, social, cultural, and even technological lessons that can support the successful implementation of CBDCs. But before I delve into those lessons, let me just give a brief comparison between paper and digital currency. So the fundamental functioning of monetary systems is based on trust and is backstopped by central banks who ensure the persistent stability of currencies over time. Unlike a paper currency, though, where physical tokens exchange hands during trade, a digital currency is designed as a verified digital ledger that records all transactions that occur within a given system. Trust within a digital currency system, which I've mentioned is essential, is established by guaranteeing the accuracy and immutability of that ledger. CBDCs, in turn, are fiat currencies issued by central banks in digital form, which are intended to be issued either alongside or to replace physical banknotes as a medium of exchange. Right? The implementation technology of a CBDC ledger may be centrally controlled, distributed, or employ a partially distributed system. Whatever the choice that is taken, the distributed ledger must account for trade-offs in satisfying three key properties that cannot be simultaneously achieved. These are correctness, decentralization, and cost efficiency. Further, within any CBDC system, the central bank has to make critical decisions on which functions to implement directly, which functions to delegate to other institutions, and which functions to allow others to perform under supervision. Conversely, mobile money is an example of an electronic currency that is issued and controlled by a private network, usually that being a mobile network operator. Mobile money continues to scale rapidly in a number of countries globally, and we have a wide range of transactions today executed on mobile money networks, including person-to-person transfers, which account for the largest share of mobile money activity, but also airtime purchases, international remittances, and bill, merchant, and government payments. So what lessons then does Africa's experience with mobile money shed for the deployment of CBDCs? The design, regulation, and operation of mobile money networks, as well as the wealth of empirical evidence, offers important lessons for the deployment of CBDCs. I'll categorize those lessons into four key areas or segments. Those are regulatory lessons, technological lessons, economic lessons, and sociocultural. The context is very important though, and the relevant lessons apply somewhat differently across advanced, emerging, and developing economies. I highlight here some of the key lessons within the context of advanced economies. Let me start with economic lessons. So mobile money has had a transformative impact in economies where it has been successfully deployed. It has increased financial inclusion. It has dramatically increased the share of small value digital transactions. And it has supported household liquidity and resilience by enabling on-demand remittances. Further, the use of mobile money has increased the formalization of transactions by introducing into the digital system transactions that were previously untracked and informal. So these achievements bear stressing, especially for economies that are considering retail CBDCs. However, one major risk stands out: the impact of the cost of data on the widespread availability of digital financial services deployed by third-party vendors. Particularly, lower-income households risk being excluded from access to these services due to the high costs of data, due to the costs of smartphones, but also, I must emphasize, due to both digital ability and financial ability as well. I'll move on to regulatory lessons. The regulation of the CBDC ecosystem will play an important role in determining how successfully and how quickly CBDCs are adapted in an economy. I'll say that regulatory flexibility is critical to create an enabling environment for the growth of digital currencies. Regulation should support innovation by all players within the CBDC ecosystem and should ensure that intermediaries traditionally excluded from financial intermediation, such as mobile network operators and big data companies, are encouraged to participate in financial sector innovation. Second, in mobile money ecosystems, a legal and regulatory infrastructure to enable non-bank electronic money issuance has been a critical enabler. The key components here have included a clear definition of e-money as a distinct instrument, a legal requirement for the licensing of e-money issuers and the qualification criteria for licensed entities, and a set of activities that licensed e-money issuers are permitted to perform. These permitted activities balance the need to increase financial inclusion, while at the same time using a risk-based system to protect the integrity of the mobile money ecosystem and manage the costs of service provision. Third, mobile money experience shows that allowing piloting of innovations with oversight is an effective model. As the innovations grow in success, additional and appropriate controls can be added by the regulator. A tiered system of regulation also maximizes uptake across individuals and institutions while minimizing the compliance burden, allowing smaller businesses to face lower compliance requirements than larger corporates. And first, in the regulatory sphere, the establishment of trust in CBDCs requires careful management of transparency relative to privacy. The protection of user privacy and user-generated data has been critical to support uptake in the usage of mobile money. Trust in CBDCs can be improved by embedding regulations ensuring transparency in the collection and usage of data and requiring user consent prior to data utilization in value-added services and products. I'll also just briefly touch on technological and sociocultural lessons. First, coming to technology, the quality of the underlying technology is critical to the establishment of trust in the CBDC. It's critical to ensure persistence and availability of the technological platform through resilience to technical failure, minimizing downtime, and implementing robust systems against counterfeiting and cyber risks. The underlying system must also ensure real-time completion of transactions and account reconciliation. Second, application programming interfaces allow the deployment of critical value-added services. Within mobile money networks, MNOs have provided APIs to third-party vendors in order to enable them to build new product offerings that utilize mobile money. And this has been critical in enabling the deployment of a growing set of innovative products in credit, insurance, and even IoT, right? So in a similar vein, APIs will be integral to ensuring the widespread deployment of third-party services using CBDCs, right? And I think beyond technological infrastructure, the mobile money experience shows that education and onboarding of end users is critical to spurring uptake. Education sensitizes users on the functions that they can perform using digital currency and creates familiarity and comfort in using text or graphical interfaces in order to access services. This is particularly important for some segments of the population, including those that may not be technologically savvy, such as older individuals or segments of the population with low access and low familiarity with financial services. And I'll finally just briefly touch on sociocultural lessons. Pre-existing cultural attitudes, values, and habits are also likely to impact CBDC adoption rates. As evidenced by mobile money, some key pre-existing cultural factors have contributed to differences in the rates of adoption of mobile money based on preferences and trust. A large segment of the population within sub-Saharan Africa maintains a preference for the use of cash for transactions, even in the existence of mobile money. And this is reflected by the existence of a large cash economy, even in countries where mobile money has been very successful for a long period of time. Second, evidence from mobile money shows there are differences in the adoption of mobile money by demography. The first adopters of mobile money are typically urban, they're typically educated, and they're typically wealthier middle-class individuals. Also, mobile money has tended to be adopted first by younger people. We may see similar patterns observed in the adoption of CBDCs. And finally, evidence suggests that mobile money has had a significant impact on household behavior. The evidence shows that the use of mobile money has encouraged savings amongst households, and also the usage of mobile money for payments, credit, insurance, investment, and other financial services, thereby showing that there's an improved attitude towards the adoption of digital financial services. So, in conclusion, as the global economy enters the exciting era of the ubiquitous use of digital currencies, including the introduction and widespread use of CBDCs, these lessons can go a long way towards ensuring a successful transition. I will stop there and hand it back to you, Sonia. Thank you.
Thank you very much, Aaron. I'd say this is a great starting point to this discussion. You have analyzed the mobile money experience in Africa and summarized some key lessons. Now we'd like to also hear some different views on the aspects you presented. So here in Europe, the European Central Bank is already at an advanced stage in developing the digital euro. Katrin, you as the head of the Monetary Policy Strategy Division at the European Central Bank, maybe you can give us some insights. Where do we stand in the development of the digital euro, and what is the ECB's perspective on the introduction of digital central bank money?
Yeah, Sonia, first, thank you for having me. So I'm really pleased to be here. And I would also like to congratulate Aaron for his really nice study. And I think indeed there are a lot of lessons that we can learn from the experience in Africa with digital payments. And then I have to add the disclaimer, the usual one. So of course, I'm speaking here. I'm telling you my personal views, and I'm not speaking as a representative on behalf of the ECB or the Eurosystem. So that said, yes, the ECB is investigating the opportunity of a digital euro. So we have started with a project in July 2021. And at the moment, we are still in the investigation phase of this digital euro project, meaning that we are looking at different use cases, at different design options for this digital euro. And in October this year, or in September, the Governing Council will decide whether to move on with this project or whether to stop this investigation phase. And if the Governing Council decides to move on, then we would go to an experimentation or phase, meaning that we would then look more into how the system could be set up. So it's not about launching. So the launching is probably still a long way out, but we are very concretely looking at how a digital euro could be designed, how it would interact with our monetary policy. And I'm not part of the digital euro project team. I'm head, as you said, head of the Monetary Policy Strategy Division. So I'm mostly looking at impacts that a digital euro could have on monetary policy. And in this respect, it's very important. As Aaron already said, there are different objectives in developing countries and in more advanced economies. And for the euro area, the main objective is that we see an increasing digitalization of the economy, which means that you cannot use cash for digital payments because cash is physical, you cannot transfer it via the internet or via e-commerce. So if cash is used less and less, at some point, the public, the general public, would not be able to use central bank money for payments anymore. You may say that's not a problem because we have a lot of options to use to pay digitally, but these options are private monies. So they are not central bank money. And as a central bank, we think that a central bank does have a role in providing means of payment to the general public. So just to be clear, we do have central bank digital currency, but it's only banks who can access this. So we have digital central bank money, but it's reserves and only banks can access it. So what we are talking about is that the general public, so the citizens, can also have access to central bank money in digital form. So not only banknotes, but also digital payment. And this is important to retain some monetary sovereignty in the euro area, throughout the euro area, and to have a role in payments so that people can resort to central bank money for effective payments. And I think here it's also very much a euro area issue. We do, of course, have private solutions for digital payments, but the euro area consists of now 20 countries, and private operators, of course, tend to prefer the large countries where they have a large customer base, and small countries are much less well served through private firms, private operators. And many of these digital payment operators are not based in the euro area, which is also a strategic issue. So I think this, in the broad context, are the strategic aims of the Eurozone. So if you have listened to Aaron, I think it's quite different from the African experience, where it's a lot about financial inclusion, offering payment and banking services to the general public, improving the function of the payments system. These are not the main objectives in the euro area. So I'll probably stop there and hand it back to you.
Well, thank you. That sounds promising. Although, of course, there are different objectives to be considered. Now, switching continents, Barry, you're reporting from NetBank South Africa. Can you give us some insights as to the current implementation of digital currencies in South Africa or Africa in general?
Yeah, sure. I also just want to make a disclaimer that I'm here as an individual, not as a net banker. But if you consider South Africa, you have to, or Africa for that matter, you have to look at the duality of the economies. And on the one hand, South Africa is known for our very, very sophisticated first world wholesale banking capabilities that trickles into our retail banking capabilities. But we have this underserved, underbanked huge population. So when we talk specifically now about digital currencies, a lot of conceptual, innovative blockchain-based solutions have been tabled to banks over the past years. But what we've discovered is making them work is not easy. It's not a plug and play and off you go, as the fintechs would tell you, you just use this and off you go. There are tech challenges, the regulatory challenges, skills challenges of people understanding how the whole ecosystem fits together, but also then business model impacts and change for in the payment industry, in the established institutions. It does not come easy. So there's a lot of resistance to these changes. Over the years, the focus has been, from our perspective, really on Bitcoin. Then it moved into stable coins, and now the CBDC currencies is kind of the next evolution to stable coins in South Africa. It's mostly driven, and from our perspective, by big tech and their ambitions to build alternative tokenized payment systems as compared to the traditional card and bank-based payment systems. For us to then, in South Africa, to learn about the new current digital currencies, we believe that rather start doing stuff than to theorize. So in combination with the South African Reserve Bank, an industry-wide project was established, Project COCA. And Project COCA 1, COCA means in the indigenous language to dig. And it's really to dig and find out what's happening in the digital currency space. We started in 2018 to experiment with distributed ledger technology and a mechanism for wholesale payments between settlement banks. And that evolved into the second project, or second phase of Project COCA, where we started building an interconnected blockchain ecosystem that can clear and settle debentures, also using the same tokenized DLT technologies, where you could, again, settle and pay wholesale banking transactions. So not in the retail space, as Katrin was speaking about. We first needed to, in a almost controlled, safe environment, understand how these things work. From a Nedbank specific perspective, those two first projects with the South African Reserve Bank has now given us enough intelligence and understanding that we now starting to create our own distributed ledger technologies, and we're using a blockchain ecosystem, and we're now learning how to deploy these capabilities in a cloud, because we want to serve a much wider geography than only South Africa, and we see cloud as being the capability to go wider than our own borders. There is, however, a big dark side to this in South Africa, and we have been faced with two of the biggest crypto scams in the world so far, where we lost about $4 billion in investor wealth. So there is a bit of skepticism or criticism, or people are scared of these new technologies.
Thank you very much. You already said making it work, it's not easy, definitely. Aaron, we already heard your presentation, but maybe could you speak to the key findings of the study conducted on what you deem most important to support an appropriate legal and regulatory infrastructure for digital money?
Thank you, Sonia. As you mentioned, I already touched on this during the presentation, but I think I would highlight 3 key points. The first being, again, regulatory flexibility. You'll find in the case of mobile money, the flexibility that was accorded to non-banks to be able to begin issuing mobile money as an e-currency is really what supported innovation in this space that then led to the flourishing of mobile money, right? So there are various ways, and I think there are various tools that do support creating a flexible environment. Nowadays, we have quite a number of countries that are implementing regulatory sandboxes. And so I think this is just something that should be encouraged, particularly because you find a lot of the innovation with mobile money has come not necessarily from traditional financial institutions, but from non-banks, right? So big data firms, mobile network providers, right? And even when you look at the third-party vendor services that are being built on top of mobile money platforms, a lot of the times these are coming from fintech firms, right? So that regulatory flexibility really, really helps. Second, and I think quite related to the first point though, is again, you need to create a safe environment. And this is where a clear definition, both in terms of e-money as a financial instrument, and also a clear definition of the activities that various tiers of licensed institutions are allowed to perform also becomes quite critical. So, for example, you'll notice some countries take a regulatory stance where they will regulate institutions, while other countries tend to lean more towards regulating services, right? And the latter type of regulatory framework also tends to be slightly more flexible, because when you regulate services, then various types of institutions, as long as they meet those regulatory requirements, can then participate in those markets, right? And third, I would also say that the issue of tiered regulation is quite important, because you also do have compliance, right? And so one particular aspect that has also helped mobile money, I think, advance quite rapidly is the fact that you have tiers of regulation based on the types of services that various vendors actually offer, right? So if you're simply performing and you're licensed to do transfers, then in some countries you'll have lower regulatory bar than, say, other institutions that are providing perhaps a larger set of financial services. Thank you, Sonia.
So I've heard regulatory flexibility, safe environment, and tight regulation. And another part of an appropriate legal and regulatory infrastructure is also to ensure the protection of user privacy. I want to get more into that. Katrin, what regulations need to be taken into consideration to ensure the responsible collection and storage of user data according to EU regulations?
Well, first, it's obvious if you perform payments for the broader public that a host of data is accumulating. And of course, many firms are very keen on making use of this data. And as Aaron said, it's mostly big techs and fintechs who are more apt in making use of this data than the traditional banks, who, at least in the euro area, have been kind of slow in exploiting this data. So when we go to CBDC, of course, the central bank does not have a commercial interest in collecting and exploiting this data. In contrast, so the central bank would try to set up a system so that the central bank itself cannot see who is holding the CBDC and what is being performed with the CBDC. So it's in a way like cash, but as it's digital, you of course have better means to enforce anti-money laundering and other regulations, because privacy doesn't mean anonymity. So there is a well-known and legitimate objective of private agents that their payments data is private, but this shouldn't be used in a way that it can conceal illicit transactions. So there should be compliance with regulations in that field. And of course, this compliance has to be ensured. So the system has to protect privacy, but it should also make sure that there is no complete anonymity, but these regulations are enforced. And of course, for a central bank, it's key that the product that the central bank offers is compliant with the current legislation. So there cannot be complete anonymity of all kinds of payments, and the existing regulation in that area has to be enforced.
There should definitely be compliance. Barry, how do privacy regulations in Africa might differ from Europe? What is done there in order to ensure the security and privacy of users' digital money transactions?
Yes, in Africa, it's a big continent, but in Africa, it differs in several ways. The European Union has implemented the GDPR, which is a highly respected regulation. But in Africa, there are differences from country to country to country. Many countries do not have a comprehensive privacy regulation in place. In some we do, South Africa and Kenya. I'm sure Aaron can attest to that. We have implemented data protection laws that are similar to the GDPR in some respects. It achieves the same objective. There are many other measures to ensure your data is protected from a technological level, and those are being used in Africa. It's encryption, authentication, access controls like mobile multi-factor authentication to verify the identity that you're dealing with. So there's all of those protection mechanisms in place. But to comply with the trust demand placed on banks and payment processors, we all have to have policies and procedures to govern the collection of data and protection thereof. And so from that point of view, to stay in business, these policies and procedures would typically include provisions of obtaining approval from the users. Can we use your data? How can we use your data? And then also implementing the appropriate security measures that other people can't get access to your data to protect your personal data. So those topics are foremost of mind in most payment players in Africa, but it's not as heavily regulated across multiple countries as in Europe. But I think we will, over time, also migrate to a uniform standard of protection and regulation, especially with the advent of cloud, where we operate across geographies from a central point.
Thank you very much for your insights. At this point, I would like to include a question from the audience because it's also concerning data privacy, and it's how safe is CBDC according to cybersecurity? What if it gets hacked by Russian, Chinese, or USA? Maybe Katrin or Aaron, you're also.
Yeah, maybe. So, of course, cybersecurity and the technology side is not my key area of expertise. And what is envisaged for the euro area is a tiered system, so that the central bank operates the payment rails, so the backbone of a CBDC, whereas the banks do customer onboarding and the customer-facing work. And with the operation of payment rails, of course, a central bank, the euro system, has already some experience. So this would, yeah, of course, it has to be very safe. It has to be trustful. But yeah, there is, central banks have been operated the wholesale payment systems for decades. So there is a certain kind of experience. And I think this experience will also help in case a CBDC or a digital euro were issued.
Thank you for your answer. Now, beside privacy concerns, we also have another topic. Access to supporting technology is also crucial to support successful implementation. To quote from the study, Aaron, trust in mobile money systems is directly linked to the quality of the underlying technology. Katrin, I will come back to you again. What is your take on that? How can we ensure the resilience of mobile money systems against counterfeiting and cyber risks?
Sure. Thank you very much for the question. I think that the very successful uptake, I mean, not all implementations of mobile money are successful, but studies have shown that in all countries where mobile money has been successful, the underlying technology and the underlying security of the system has been robust, right? And by robust, I mean in terms of both ensuring real-time completion and settlement of transactions, right? Both in terms of actual transfers and in terms of messages that do confirm the completion of transfers. And then second, I think a core component of that has been a robust dispute resolution system, right? You do have cases where perhaps transfers are made to wrong individuals, or you might have cases of fraud, identity theft, etc., that do result in unintended transfers of funds, right? And so there are dispute resolution systems in place that tend to be very effective and responsive, right? So these are quite critical towards ensuring that users do not lose trust in the mobile money system, right? So I think countries where we've seen the technology fail, or we've seen security repeatedly fail, have also seen a decline in the use of mobile money.
Now I have a question for Barry, because I think it would be interesting to hear your perspective. You already said that there were two biggest crypto scams in Africa. Have there been any incidents you can report on where the technological systems behind modern mobile money systems have failed?
Yes, if we talk technology specifically, not the security components that Aaron has referred to, absolutely. There has been system failures across the continent. That in 2019, there was a big MTN Uganda failure where customers could not get access to their money for several hours. This was due to a pure hardware failure. And banks and mobile money providers are really attuned to the fact that it's a 24/7 service. And since 2019 to now, I can tell you that the monitoring capabilities and the predictive analytical capabilities have evolved to such an extent that the mean time to repair these outages have reduced to 1 or 2 hours. In South Africa, for example, the regulators insist that we run failure tests and that we've got target time sets for when and how fast we can recover. And we test these 2-3 times a year, and we get audited on them and report back to the regulator that we are in fact able to recover these systems, because we fully understand the level of instability we can introduce to an economy that is really sensitive for daily transactions, and we take it really seriously. I think from a evolving perspective, where we're going to cloud and consuming platform services, payment platform services that are designed to be inherently redundant and robust, is the next level where we're going to, that you would almost not notice any technical failures in the future, unless it's network or Wi-Fi or however your last mile connection related that we haven't covered yet.
Great. That would be the next level. We have to ensure a working technological system. But what's also important is the access to the system for everyone. Let's move to the topic of financial inclusion. We already touched upon that before. Aaron, you've also, I'd like to hear your opinion. How do you assess the importance of financial inclusion as key to successful implementation of digital money?
Thank you, Sonia. I think, at least in the context of developing and emerging economies, financial inclusion has been the major success story, right? When you look at the number of unbanked or underbanked individuals that have been included, the numbers speak for themselves, right? But perhaps what I would like to emphasize here more, which is not spoken about as much, is universal financial inclusion, and how important that then is within the context of digital currencies such as CBDCs, right? So I think some real constraints do come up. And these are real both in the context of developing and advanced economies. And of course, they would depend on the type of CBDC infrastructure that is set up. So for example, if you have maybe mobile wallets, for example, then you do have to consider various aspects of inclusion. I think one being the actual costs of handsets, the costs of data as well. These perhaps are quite major concerns when you talk about universal inclusion in developed economies, but also when you look at some segments of the population in some advanced economies, those are also issues to contend with. And then I think beyond that, when you look at aspects around what I mentioned, digital ability, and also, let me call it financial education as well. Those are aspects that are not perhaps universally at the same level across all segments of any given country's population. And those have real effects in terms of determining to what extent you then achieve universal financial inclusion. Thank you.
Thank you. So apparently financial inclusion is definitely important to consider. And as Catherine said before, not so much in Europe, but I'd guess even more so in Africa. So Barry, from a South African perspective, what measures are being taken to ensure that vulnerable populations, for example, low income and rural households, have access to basic financial services?
If you just consider for a moment that banks are capitalist in nature, and they will follow the money where they can make the most money. So it's not natural for a bank to venture into full financial inclusion of the unbanked, because the margins they can make and the number of sales, that's just not there. So our Reserve Bank and our regulatory framework was adjusted to open up this closed network that the banks were running, to allow fintechs and network operators and payment operators into the financial processing system. That forced banks to wake up and up our games and to become much more innovative, so that we have to almost fight back. And I think that was initiated by the government to get the banks going. So since the past few years, there were a couple of very innovative high-tech, tech-dependent projects launched to include the underserved. And one, for example, it's just gone live recently, or the test phase has gone live as a rapid real-time payment processing system that does not run on the typical card bank railways. It's a new interbank capability that is priced so low that you wonder what the pricing strategies for the bank is going to be. It's really to bring people into the financial system and then educate them and almost make banking free without having to own a bank account. So I can start paying people, but I don't own a bank account. And it's not the typical mobile money platforms. What's also happened is the regulation forced us to look at protecting the consumers, the new entrants into the banking world, where they're being caught unawares by overzealous, call it insurance salesmen or funeral policy salesmen, where the money gets deducted, or micro lenders, where money gets deducted out of their accounts, and by the time they have to live, there's nothing left. So there's a authenticated collection program that's successful, it's working, protecting those consumers. We call it debit check. Then apart from that, all the banks, because we're so fiercely competitive and we're being forced to be able to serve the underbanked, we've developed capabilities where off a mobile phone, there's a lot of free access to banking services. Plus, then you can pay people out of a bank account to a mobile telephone, and they can walk up to the recipient of the money can walk up to any ATM and punch in the number and get the cash out. You cannot forget that cash is still big in Africa and big in South Africa. So it's a form of money transfer, but that's how you bring people into the financial system. We still have also a lot of people using normal older phones, not smartphones. So our USSD banking capability, we keep on maintaining it, and it's used widely. So if you look at the non-financial services infrastructure, I'm talking access to data, Wi-Fi, I can see that in the end, banks and telecom companies has got a joint objective, and that is to get people connected. In the end, a bank in a rural community might just be a Wi-Fi point with mobile phones that are provided at prices that are affordable, is to bring people into the system. It will allow us to scale, give us agility, better security, and present these banking services at a much lower cost point. I think that's where we're heading towards.
It's good to hear that there are systems in place in order to ensure financial inclusion. Before we move on, let me take a quick break here to include some questions from the audience, because we have a lot here. One question for Catherine, maybe. It's Sebastian Heckler says approximately 100 central banks work on digital currencies. Is it planned to link these currencies? Do you have information on that maybe?
Yeah, we may probably talk about that also later on. So of course there is a lot of talk and work on making central bank digital, or thinking about how to make central bank digital currencies interoperable internationally. So a lot of this work is done at the Bank for International Settlements. And as currently none of the major economies has a digital currency, central bank digital currency, it's probably a good time to think about how to set up such a system and how to also link that. It's clear, so when you go for a blockchain, and we have to say, so there was a lot of talk on the technology, and it's not set in stone that a central bank digital currency would run on a blockchain. So it can run also on a very traditional account-based system, or having online and offline functionalities where the offline digital currency is stored on kind of a chip card or something like that. So there, regarding technology, there are a lot of options that can be pursued and that are being investigated. But when you go for these international interoperability, a blockchain, of course, is very handy because you can directly have these systems communicating with each other. But you have to think, so we all know that remittances are extremely expensive, but this is only partly owing to the technology that's underlying these remittances. A big part is also by international regulations. So different countries have different regulation. To bring money from country A to country B, you have to fill in different forms. Each country is asking for different information in a different format. And harmonization of this regulation would already go a long way in reducing cost of international remittances. So we shouldn't think that central bank digital currency is the silver bullet to lower the cost of international transfers. It may play a role in that, but other parts of the system would have to move as well to make international remittances cheaper.
Thank you for your assessment. I have another question from the audience. I would like to ask it to Aaron. It's, could you give a practical example for a use case and their advantage in comparison to current existing money systems of using of CBDCs for non-financial institution users? Why should ordinary people use CBDCs?
Thank you very much, Sonia. I think I just give a very practical example, for instance, here in Kenya, right? And this might make it quite clear. Suppose you have the need to pay workers on a farm in a rural part of the country. The way this would typically work, at least in the past in Kenya, is you would need to find a way to get the cash, physical cash, over to that particular worker or set of workers, right? But and you have time, right, between you getting the request and then getting the money over to that person. With mobile money, this became more or less instantaneous, just apart from the transaction cost that you had to account for, right? And so when you look at a CBDC or any other digital currency, as long as you have a mobile wallet, right, then you very quickly increase the efficiency with which you can perform payments, with which you can perform transfers. And that's sort of been the underlying reason why mobile money actually started and was quite successful, right? So I think that translates directly into a digital currency.
Great, good to include a specific use case from Kenya. From what we've heard until now, digital money is definitely on its way, and it will have a major impact on the financial system. So, Barry, what is your take on this topic? To what extent will the implementation of digital money impact the financial system? locally and also globally?
My sense is that also linked to, if you use the use case that Aaron just used, mobile money's been around in Africa for a pretty long time. And that's how we pay person to person. That's how we pay person to business. But we're using typical bank card, expensive railways to transfer the money, clear and settle through the regulated system. My sense is that CBDCs will potentially turn that whole industry upside down, because what you do with that, as long as it's properly regulated, but what you do with that, it's pure digital, tokenized transfer instantly without having back offices, with taking out a lot of the dispute resolution processes, because it is more accurate and hopefully more secure in the end. So I think the financial system is about to change fundamentally, but it's always the thing is you always expect things to change faster, and then it takes longer and it's more difficult to get there. But I think CBDCs will definitely change the financial system fundamentally.
So interesting times coming. You said all industry will be turned upside down through that. Katrin, how do you see digital money complementing traditional cash, and what impact could it have on the financial system? Can you maybe foresee how strong cash transactions will be affected?
Well, it's very hard to make any predictions because we haven't seen a central bank digital currency in a major economy. And so we don't have data to know what's going to happen if it were to be introduced. But what is clear is, of course, that cash will remain in place. So the European Central Bank has committed to maintaining cash operations as long as there is a demand for cash. So it's not that we from the central bank would have any ideas of phasing out cash. It's only that we observe that more and more transactions are moving into the digital sphere. And if you look at the payments at the point of sale, currently there are about 40% that are non-cash. So even relatively small value payments, the share of non-cash transactions is increasing. And this is just the point of sale. So if you think of the payments you are affecting in your daily life, there are a lot of payments that you do via bank transfer anyway. So that has been said, that cash will remain there. And it's also clear that CBDC would be issued in a tiered system. So where there are supervised intermediaries that do the customer-facing thing, and that the ECB would issue a digital euro through these supervised intermediaries. So the current two-tier monetary system will stay intact. And yeah, there will certainly be changes for financial institutions in the sense that probably the deposit base might decrease because people would hold less deposits and do less payments through their deposit accounts. But on the other hand, banks probably would be able to also derive income from performing the issuance and the distribution of a digital euro to the economy and to customers. So we have committed that retail users should not face any fees like it's currently with cash. But of course, in the background, there will be a system operating, and there would be compensations that are there in the system, like nowadays with card payments. But these are things where the discussion is ongoing, and there has no decision or no view already been formed on that. But also think about new technologies. So I don't know, you probably weren't around when the internet started and everybody said you don't need an internet. What are you going to do with that? And now we cannot live without it because there is such a wealth of information in the internet that we really benefit a lot in our daily lives from that. And I would think that with a digital currency, it could be the same. So currently we cannot imagine what kind of services can be added to such a digital currency. But once it's around, And Aaron said we should embrace innovation. So there will be maybe smart contracts, automatic settlements that are linked to such a digital currency. So I believe that over a course of a few years, we will see products that we cannot imagine at the moment. And I would be confident that the financial sector would also benefit from these developments.
Thank you. I like how you said we should embrace innovation. Definitely agree on that. Before we move on, one more question from the audience to have everyone on the same page, because I had two questions on that. And maybe Aaron, you could answer that for me. And can you maybe explain what exactly is the difference between mobile money and existing online banking systems? It's not quite clear for everyone.
Okay, sure. So mobile money is e-currency that is issued on a private mobile telephony network, right? So it's actually a proprietary system that is fully backed in some cases by actual currency holdings that are deposited within banks, right? For instance, in the system of Kenya, right? So perhaps a bit of context there that then also helps. Mobile money tends to be quite effective in locations where you have a high penetration of mobile phone usage, but then you may not necessarily have a similarly high penetration of traditional banking services, right? So, for instance, if you have certain parts of a country where, as we mentioned, sometimes it's just not profitable for banks to have a presence, right? But you do have people there that use mobile money, then it becomes a pretty effective way to then get those particular individuals financially included. In contrast to, I think, existing banking systems, which first and foremost run through bank-operated networks, as opposed to mobile telephony networks. And there, instead of having an e-currency instrument per se, right? You actually have ledgers, and you have a transmission of and reconciliation of transactions, right? So I hope that helps to clarify.
Thank you for your explanation, Aaron. It's already past 8. This web talk today is also an opportunity to bring in different views from Africa to Europe and vice versa. And in order to further foster that exchange, Barry, what measures can warrant an effective collaboration between governments, financial institutions, and other stakeholders to ensure the successful introduction of digital currency systems?
I'm convinced that we need to move towards international standards to ensure that these systems can operate and are compatible, because they're different systems, so that we can do cross-border payments and transactions flow. Then we need to look at regulation, harmonizing regulation between different countries, that we don't have different regulations that make it difficult for money to flow. And then a big part is what we're doing tonight is sharing information, best practices, trends, learn from one another, because you've got to unlock this digital innovation, and if we don't progress talking to one another, we're going to go in different directions. Then payment infrastructure, or mobile payment and digital payment infrastructure, is really essential. And then to do that on a regional basis, so say for example a Pan-African payment settlement capability that facilitates the flow of money once again. And then public-private and private partnerships could unlock a lot, where we partner with, for example, a Microsoft in how we tackle Africa and get the infrastructure in place, and partner with telecom providers to unlock the infrastructure, because it's all about data, and we've got to bring the cost of data down and accessibility. If we can crack those few things, I think new age digital currencies will be prolific.
So to summarize you, we need international standards, harmonizing regulation between the countries, sharing information like we're doing today, and of course, a good payment infrastructure. And last, I'd also like to hear Katrin's opinion. What do you propose? How could a framework for international cross-border use of digital currencies possibly look like?
Well, from central bank's perspective, of course, all central banks have a domestic mandate. So what they are doing is they are providing access to payments and access to the domestic currency for their residents and their citizens. And there are a lot of risks in moving towards a central bank digital currency. So for example, there is a study by the IMF looking at the legal frameworks in countries, and not every legal framework provides for explicit permission to issue a digital currency. So there has to be a lot of work done only on that field. We have talked about risks to the financial system that are also obvious, because it could upset the banking sector. And of course, no central bank wants to upset the banking sector. We know how financial crises, how badly they impact on the economy. So central banks have to move gradually and have to really look at all the risks. And the focus first is to get the introduction in the domestic economy right. And cross-border and international adoption or international linkages are secondary. Of course, it's necessary to have these systems interoperable, but for example, the Euro system is thinking of imposing a maximum holding limit to be able to contain risks to the financial sector by, in case of systemic crisis, to limit the run into a digital currency. If you adopt certain holding limits for the Euro area population of a reasonable size, so there have been figures around of 3,000 euro. Think of an African country. If this 3,000 euro would also apply to a citizen in Kenya, this would be a quite different amount in terms of GDP per capita for such a country. So with regard to international adoption, I think we should move rather slowly. We should first see whether it works in the domestic economy. We should think about international interoperability by having the regulation and the current standards in mind, and probably easing and lowering costs of international transactions. But I think really looking at adoption in an international context is something that is not a first-rate objective at the current state. So that's why most central banks do their domestic-focused developments with very different motivations in the background. And then we have the international fora like the G20, the IMF, the Bank for International Settlements, who try to coordinate and to harmonize the thinking and the developments.
Thank you. So you say we first see what works in a domestic economy and then move from there rather slowly. Thank you very much. This talk is slowly coming to an end. In order to wrap up this discussion, I have one final last question to all of you, a bit looking into the future. Where do you see digital money in 10 years? Aaron, I would like to start with you.
Oh wow, that's a difficult one to answer, because I think there are so many permutations that are possible, just given all the the activity and all the innovations that we see in this space. But I think we can definitely say a couple of things for sure. First is digital money, I think, stands to sit as the underlying engine under which the digital economy will grow, right? And could actually contribute to a much more integrated global economy. And second, I think, as has been mentioned by both Barry and Katrin, we'll also see a changing role in financial intermediation as far as banks are concerned, as we see other innovative players also come into this space. Thank you.
Thank you very much. Next, Barry.
My sense is that 10 years from now, we would have a much more holistic approach to digital money that incorporates some of our ESG, environmental, social, and governance objectives, which is highly topical now. But I think we will move away from a purely local fixation to more global interoperable world where digital money enables that at a much lower cost point to benefit society and the environment. I think these over-regulated concepts are just adding cost and feeding bureaucrats and making it impossible for emerging economies to compete properly. And therefore, I think we will see a much bigger drive towards sustainability from a payments perspective.
Great, thank you. And last, Katrin, please.
Yeah, so I would take a retail consumer's perspective, and I already shared some of my thoughts on that. So I think in 10 years, we probably pay without really noticing what is behind a payment. So the times that you go to the cashier and to start picking your coins out of your wallet and having the small change is probably gone, and you just pay with a fingerprint without thinking a lot about what is needed in the background to make this payment. So I think it will become even more convenient. So I think Europe is probably behind other economies in Asia that are already very far with digital payments and mobile money. But I think, yeah, digital money in 10 years is probably something that I just tell my smartphone, please pay that bill, and then the thing is done.
Great. Let's see what the future holds. Thank you very much for sharing your expertise on this topic. We touched upon lots of aspects around digital money, from privacy and data protection to financial inclusion, the financial system in general, and of course, how international collaboration can be improved. So thank you very much for your time. It was a great pleasure to have you here on the panel. And also, thank you to our listeners for all your questions. There were a lot. I'm sorry we couldn't include all your questions, but it shows the topic is definitely of high interest. And I hope you still all enjoyed this discussion. And with that said, I wish you all a nice evening. I would close the Zoom meeting now and hopefully see you soon at one of our other events. Bye and thank you.